Disclaimer.
It has finally happened. While the financial world was bracing for a standard weekly close, January 16th, 2026 will now go down in history as the day the paper wall of Wall Street finally collapsed. Silver didn't just break through 88, it annihilated the very logic of the algorithms that have held it hostage for decades. Right now, in the eerie silence of this Saturday morning, a level of chaos is unfolding behind the closed doors of the world's largest bullion banks that we haven't seen since 2008. The 378-to-1 trap I have been warning you about for months has officially sprung, and this time there is no emergency exit for the shorts. Something broke in the financial system this week, and most Americans have no idea it happened. Thursday afternoon, January 16th, silver closed at $88.30 per ounce. That number might not mean much to you right now, but to the major banks trading silver derivatives, that closing price triggered something they've spent decades trying to prevent. Their algorithms failed. The automated systems designed to suppress silver prices by flooding the market with paper contracts simply couldn't keep up with the physical demand anymore. Think about how our financial markets actually work for a moment. When you buy a share of stock or a commodity contract, you're not really buying the physical thing. You're buying a promise that you could get the physical thing if you wanted it. It's like having a coat check ticket at a restaurant. The system works perfectly as long as not everyone shows up to claim their coat at the same time. But what happens when the restaurant only has one coat for every 378 tickets they've handed out? That's exactly where we are with silver right now. According to data from the COMEX Futures Exchange, there are 378 paper claims for every single ounce of physical silver in their registered vaults. For years, this worked because almost nobody actually wanted to take delivery of the metal. Traders would buy contracts, make their profit or loss, then sell the contract to someone else. The physical silver just sat there, supporting an ever-growing pyramid of paper promises stacked on top of it. The banks running the system built sophisticated algorithms to manage the whole operation. When silver prices started climbing too fast, these automated programs would instantly create thousands of new short positions, essentially betting that silver would go down. This flood of selling pressure would push prices back down before physical buyers could drain the vaults. It was elegant, profitable, and completely legal. The algorithms could react in microseconds, faster than any human trader, maintaining what the banks called price stability and what others might call price suppression. Here's where it gets interesting. On Thursday, those algorithms made their usual move. Silver was climbing toward $90, so the systems automatically generated massive short positions to push it back down. But this time, the buying didn't stop. Physical buyers from Asia to the Middle East kept purchasing, kept demanding actual metal, and the price kept rising despite the algorithmic intervention. The technical term for what happened is a gamma squeeze. And if you followed the financial news over the past few years, you might remember hearing about similar events with certain stocks. In simple terms, it means that the people who sold short positions now need to buy silver to cover their bets. But their buying creates more upward pressure, which forces more short covering, which creates even more buying pressure. The algorithms that usually prevent this couldn't process the volume fast enough. They were designed to manage normal market behavior, not a coordinated global rush into physical metal. Pop quiz. How much silver do you think is actually available for delivery in COMEX warehouses right now? The official registered inventory shows roughly 30 million ounces. That sounds like a lot until you realize that outstanding contracts represent claims on more than 11 billion ounces. Even more concerning, according to warehouse receipts filed with the exchange, most of that registered inventory is already pledged as collateral for existing positions. It's technically there, sitting in the vaults, but it's legally encumbered, meaning it can't actually be delivered to new buyers without triggering defaults on existing contracts. We've reached what traders are calling the critical strike level. The remaining deliverable silver has effectively hit zero. Now imagine you're a bank with a massive short position in silver. You've been running this trade for years, making steady profits by selling paper contracts while the price stayed suppressed. Your risk model said everything was fine because silver never moves this fast, and your algorithms would always catch any rally before it got dangerous. Then Thursday happens. Silver closes at 88.30, your automated systems can't contain it, and suddenly you're looking at margin calls that exceed your Tier 1 capital reserves. This is what the weekend panic is really about. Major bullion banks spent Friday night and all day Saturday in emergency meetings, trying to figure out how to meet margin requirements when the market reopens Monday morning. According to sources familiar with the situation, several institutions are facing liquidity demands that would require them to liquidate other positions or seek emergency funding just to keep their silver operations from triggering broader systemic issues. Think about what this means for your own financial reality. If you own shares in any major bank that deals in precious metals derivatives, you need to understand that their balance sheets might be carrying enormous hidden losses right now. If you've been considering buying physical silver as insurance against currency devaluation, you need to know that availability is about to get much tighter, possibly within days. And if you're invested in silver mining companies, you're about to see a dramatic shift in how those stocks are valued relative to the banks that have been shorting their product. The Federal Reserve's own data shows that U.S. banks hold approximately $240 billion in precious metals derivatives exposure. Most of that is in gold, but the silver positions are particularly concentrated among just 4 or 5 institutions. When one concentrated bet goes wrong this dramatically, it can cascade through the entire system in ways that affect everyday Americans far beyond the commodities markets. Here's what should really grab your attention. This isn't a conspiracy theory or prediction about what might happen. This already happened. The closing price on Thursday already triggered the margin calls. The algorithms already failed. The question now is not whether the banks have a problem. It's how they are going to solve it before Monday's market open. You know how sometimes a small crack in a windshield suddenly spreads across the whole glass when the temperature changes? That's what we're watching in real time with the silver market. The structure was always fragile, held together by confidence that the paper system would never be tested by actual delivery demands. But once that confidence breaks, once enough people realize there's no coat behind most of those coat check tickets, the crack spreads fast. The banks designed their systems to be unbeatable under normal conditions. Their algorithms were faster, smarter, and better funded than any individual trader or even groups of traders could ever hope to match. What they didn't account for was a scenario where normal conditions simply ended, where buyers around the world simultaneously decided they wanted the physical metal regardless of price. And where the available supply couldn't possibly meet that demand at any price the algorithms were programmed to manage. This weekend, while most Americans are watching sports or planning their week ahead, some of the largest financial institutions in our country are facing a moment of reckoning that could reshape precious metals markets for a generation. The ghost in their machine just revealed itself, and it's not going back in the box. What happens next depends on decisions being made right now in boardrooms and emergency conference calls across the financial world. But one thing is already certain. The game that's been played with silver for decades just ended. We're entering new territory now, and most people won't even realize the landscape has changed until they try to buy silver and discover it is not available at any reasonable price. The algorithms died Thursday afternoon at 88.30. Now we find out what rises from their ashes. If you want to know where the real action is happening in silver, don't watch the price on your brokerage screen. Watch the gap between what silver costs in London and what it costs in Shanghai. Right now, that gap is screaming a warning that most American investors haven't even noticed yet. According to data from the Shanghai Gold Exchange, physical silver is trading at a 15% premium compared to London spot prices. Think about what that actually means. In a normal functioning market, prices for the same commodity shouldn't differ by more than the cost of shipping it from one place to another. But we're not talking about a 2 or 3% difference to cover transport and insurance. We're talking about 15%. This is the Shanghai-London arbitrage, and it's telling us something crucial about what's really happening behind the scenes. When physical metal in Shanghai costs 15% more than paper contracts in London, it means one simple thing. Buyers in Asia are willing to pay a massive premium because they understand that London's paper prices don't reflect physical reality anymore. They're not buying a promise or a contract. They're buying actual metal they can touch, store, and own outright, and they're paying whatever it takes to get it. Have you ever tried to buy something during a shortage? Maybe concert tickets when a popular artist comes to town, or a specific toy during the holidays? You know that feeling when you realize the official price doesn't matter anymore because nobody's actually selling at that price. That's exactly what's happening with silver on a global scale, except the stakes are measured in billions of dollars and the shortage involves one of the most important industrial and monetary metals on Earth. The flow of physical silver tells the story that paper prices are trying to hide. Trade data from the London Bullion Market Association shows that vault inventories in London have dropped by nearly 40% over the past 6 months. Where did that metal go? Track the shipping manifests and customs records and you'll find the answer. East. China, India, Singapore, and the Middle East have been systematically draining Western vaults of physical silver, while Western traders have been distracted by the paper price staying relatively flat. In the fourth quarter of 2025 alone, silver exports from London to Asian markets spiked to over 350 million ounces, a 75% increase from the previous year. And here's the critical detail. Most of that silver isn't coming back. When a Chinese manufacturer buys physical silver for industrial use, or when a Middle Eastern sovereign wealth fund adds it to their reserves, that metal exits the tradable pool permanently. Despite silver prices climbing substantially, scrap supplies are actually declining according to the Silver Institute's industry data. Anyone sophisticated enough to understand the current market dynamics isn't selling their physical silver at these prices. Here's where it gets even more revealing. The SLV ETF, which is supposed to track the price of physical silver, has been showing some very strange behavior lately. According to the fund's own disclosure documents, they're required to hold physical silver to back the shares they issue. But when you dig into their actual inventory reports filed with the SEC, something doesn't add up. The fund has been issuing new shares to meet investor demand, but their reported physical holdings haven't been increasing at the same rate. The creation and redemption data shows that authorized participants, large institutional investors, have been consistently redeeming shares and pulling physical silver out of the fund, while retail investors buy shares on the open market, assuming they're getting exposure to physical silver. BlackRock, JP Morgan's commodity desk, and several sovereign wealth funds have all reduced their SLV holdings over the past year, while simultaneously increasing their positions in physical silver stored outside the ETF structure. The smart money is converting paper positions into physical metal and taking it out of the system entirely. Let me put this in perspective with a scenario you can relate to. Imagine you have money in a bank account and you hear rumors that the bank might be having problems. What's your first instinct? You go to the ATM or the branch and withdraw your cash, right? That's exactly what's happening in the silver market right now. Except instead of individuals lining up at ATMs, it's sovereign wealth funds, pension managers, and billionaire family offices quietly draining the vaults. The London Bullion Market Association, which sets the global standards for precious metals trading, is facing a crisis they never prepared for. According to sources familiar with ongoing discussions, the LBMA held emergency meetings this past week to consider an unprecedented move, switching to cash-only settlement for silver contracts. Read that again because it's important. Cash-only settlement means that instead of delivering physical silver, when a contract comes due, they would simply pay you the cash equivalent and close out the contract. Why would they even consider such a drastic measure? Because they're staring at a mathematical impossibility. The paper-to-physical ratio has created a situation where actually delivering on all those promises would require more silver than exists in their entire system. Leaked internal risk assessments suggest that if even a small percentage of contract holders demand physical delivery this month, the LBMA's member banks would face immediate default. This is not a temporary logistics problem like the brief gold dislocation in March 2020. We are dealing with a structural shortage of physical metal combined with unprecedented demand from buyers who don't trust the paper system anymore. Think about what cash settlement really means for a moment. It's essentially an admission that the physical metal isn't there. It's like the coat check restaurant saying, "Sorry, we don't actually have your coat, but here's some money to buy a new one." Except in this case, there are no new coats available to buy at any reasonable price, because all the coat manufacturers sold their inventory to buyers in Shanghai, who paid that 15% premium to make sure they got the actual product. Now let's talk about something that should be front-page financial news but has barely been mentioned in mainstream coverage. Look at what's happening with silver mining stocks compared to the banks that have been shorting silver. Major North American silver producers like Silvercorp Metals and Hecla Mining have seen their stock prices surge over the past 2 weeks, while banks with known precious metals trading desks have seen their share prices decline. This divergence tells a powerful story. Institutional investors are rotating out of financial institutions and into companies that actually control physical silver in the ground. A silver miner with proven reserves doesn't need to worry about paper-to-physical ratios or delivery failures. They own the actual metal, still in the ore, and as physical silver becomes scarce, those resources become exponentially more valuable. According to SEC filings, several large hedge funds increased their positions in primary silver producers by more than 50% in the fourth quarter of 2025, while reducing or eliminating their holdings in the largest bullion banks. Bridgewater Associates increased their stake in Pan American Silver by 43%. Millennium Management nearly doubled their position in First Majestic Silver. We're talking about institutional allocations worth hundreds of millions of dollars shifting from the financial sector into the mining sector in a very short time frame. Even more telling, several mining companies have started refusing to engage in forward-selling agreements with banks. Traditionally, miners would sell a portion of their future production at fixed prices to secure financing and hedge their risk. But in the last 6 months, at least 4 major silver producers have publicly announced they're ending these arrangements, preferring to keep their production uncommitted so they can sell into the spot market at whatever price prevails. When the miners themselves are betting on dramatically higher prices and refusing to lock in current rates, that should tell you something profound about what the industry experts see coming. Have you noticed that your financial advisor probably hasn't called you about any of this? Most retail investors are still holding their money in traditional stock and bond portfolios, completely unaware that a major shift is happening in the commodities markets. The institutional players aren't waiting for confirmation or for mainstream media to explain what's happening. They're acting on the data right now, moving billions of dollars based on the same signals I'm sharing with you. Here's what the arbitrage and the ETF dysfunction and the mining stock divergence all point to. We're watching the paper silver market and the physical silver market split into two completely different realities. The paper price is what you see quoted on financial websites and trading platforms. The physical price is what you actually have to pay to get real metal in your hands. And that gap is widening fast. The Bank for International Settlements, which serves as the central bank for central banks, publishes quarterly data on derivatives exposure in the precious metals markets. Their most recent report shows that net short positions in silver derivatives reached an all-time high in the fourth quarter of 2025. Translation: banks made enormous bets that silver would go down or stay flat, and those bets are now catastrophically wrong. When professional traders talk about a market being dislocated, this is what they mean. The normal relationship between paper and physical, between futures and spot, between East and West has broken down. Price discovery isn't working anymore because the two markets are operating on completely different supply and demand dynamics. You know what's really interesting about the Shanghai premium? It's not just about silver. Gold is showing a similar but less extreme pattern, with physical metal in Asia trading at a premium to London prices. This suggests we're seeing something much bigger than just a silver squeeze. We're witnessing a fundamental shift in how the world values and trades physical precious metals, with the Eastern markets saying they no longer trust Western paper promises at any price. The LBMA's consideration of cash settlement isn't just about avoiding immediate default. It's about buying time to restructure a system that was never designed to handle actual delivery at scale. For decades, the precious metals markets operated on the assumption that paper and physical were interchangeable, that you could always convert one to the other at the stated price. That assumption just died, and with it, the entire architecture of modern commodity trading is being forced to evolve or collapse. This is the proof that validates everything we discussed about the algorithms failing and the vaults being empty. You can see it in the Shanghai premium, in the ETF redemptions, in the mining stock surge, and in the emergency meetings at the LBMA. These aren't predictions or theories. This is documented evidence of a market in the process of breaking down and rebuilding itself around physical reality instead of paper promises. The question for you as an American investor is simple. Do you want to be holding paper promises when the music stops, or do you want to understand what's happening and position yourself accordingly? The smart money already made their choice, and they made it weeks ago. Now you know what they know. Let us talk about the math that has bullion bank risk managers working through the weekend instead of spending time with their families. Remember that 378 to 1 paper to physical ratio we discussed? That number represents the total leverage in the system across all outstanding contracts, options, and derivatives tied to silver. Now here's the question that has keeping those risk managers awake. What happens if just a small percentage of those paper holders decide they want physical delivery instead of cash settlement? Let's run the actual numbers, because this is where theory becomes reality and reality becomes crisis. According to COMEX data, there are currently contracts outstanding representing approximately 11 billion ounces of silver. The registered inventory available for delivery sits at roughly 30 million ounces. Do the division and you get that 378 to 1 ratio. But here's where it gets interesting. Most of those 11 billion ounces never demand delivery. Historically, less than half of 1% of contract holders actually take physical possession. What if that percentage changes? What if the Shanghai premium and the SLV redemptions and the LBMA emergency meetings convince even 2% of paper holders that they should demand physical delivery this month? 2% of 11 billion ounces equals 220 million ounces. The registered inventory is 30 million ounces. That means the system would need to find an additional 190 million ounces of physical silver to satisfy delivery requests. At current production rates, that represents nearly 3 months of total global mine supply. It doesn't exist in available form. It's either already committed in industrial inventory or still in the ground. So what happens when you have 220 million ounces of demand competing for 30 million ounces of supply? Basic economics tells us that price has to rise until demand falls or supply increases. But here's the problem. Silver supply is relatively inelastic in the short term. You can't just turn on a switch and mine more silver tomorrow. New mines take years to develop. Existing mines are already running at capacity. The only variable that can adjust quickly is price. How high would the price need to go to balance this equation? Financial analysts who specialize in commodity markets have run various models, and the consensus range is striking. To reduce demand from 220 million ounces back down to something the system can actually deliver, silver would need to trade somewhere between $145 and $170 per ounce. That's not a guess or a promotional target. That's the mathematical requirement to clear the market if even 2% of paper holders stand for delivery. Think about what that means for your purchasing power and your investment portfolio. If you own physical silver right now, a move to $145 represents a roughly 65% gain from Thursday's close. If you own shares in silver mining companies, the leverage on that move could be even more dramatic as profit margins expand exponentially. But if you're holding paper silver promises through an ETF or derivative contract, you might just receive a cash settlement check while watching physical silver become unavailable at any price. Have you been paying attention to the timing here? We're talking about delivery demands that could hit this month, potentially as early as this coming week. The January contract cycle on COMEX has a first notice day coming up, which is the date when contract holders must declare their intention to take delivery or roll their position forward. If the percentage of delivery demands spikes above historical norms, we'll see it in the data within days. Now, let me tell you about something specific you should watch Monday morning. The London bullion market opens at 8 a.m. London time, which is 3 a.m. Eastern, midnight Pacific. That opening price sets what's called the London Fix, and it's one of the most important price references in the global precious metals market. Banks, refiners, and dealers around the world use the London Fix as a benchmark for their own transactions. This Monday's London Open carries unusual significance. If the LBMA decides to implement emergency measures like cash settlement or trading restrictions, they would most likely announce it right at the open before trading begins. Watch for any unusual delays in the fix being published. Watch for any statements from the LBMA about temporary rule changes or operational adjustments. These would be signals that the situation is even more critical than the emergency weekend meetings suggest. There's also a possibility, though not a certainty, that we could see a trading halt. This would be unprecedented in the modern silver market, but we're in unprecedented territory. If physical delivery demands overwhelm the system's capacity and no price level seems adequate to clear the market, exchanges have the authority to pause trading while they implement emergency protocols. The Bank of England, which oversees the UK's financial stability, could potentially intervene in the bullion market if they determine that a silver crisis poses broader systemic risks. I'm not saying this will definitely happen Monday morning. I'm saying you should be aware of the possibility and understand what it would mean. A trading halt in silver would send shockwaves through commodity markets and would likely trigger significant volatility in gold, platinum, and other precious metals as traders reassess their assumptions about paper versus physical markets. Here's what you need to understand about the phase transition we're entering. For decades, silver has been in what market analysts call a price discovery phase. That means the price moved up and down based on supply and demand dynamics, but physical metal was generally available if you wanted to buy it. You might pay a small premium over spot price to a dealer, but you could get the metal. We're now transitioning into what I'm calling a scarcity phase. In this phase, price becomes less relevant than availability. It doesn't matter if silver is quoted at $90 or $145 or $200 if you can't actually buy physical metal at those prices because inventories are depleted and delivery times stretch into months or quarters. This is what happened with palladium in the early 2000s. The paper price kept moving, but if you wanted actual palladium for industrial use, you had to get on a waiting list and pay whatever the producer demanded. Several major silver dealers have already started extending their delivery times. Normally, if you order silver coins or bars, you'd receive them within a week or two. Some dealers are now quoting delivery times of 6 to 8 weeks for certain products. Premiums over spot price have increased from the typical 3 to 5% to 10% or more for physical coins. These are early warning signs that the scarcity phase is beginning. What does this mean for everyday Americans trying to protect their wealth or plan for retirement? It means that the window for acquiring physical silver at anything close to paper prices is closing rapidly. It means that if you've been thinking about diversifying some of your dollars into hard assets, the time to make that decision is now, not after the Monday morning headlines confirm what we already know. It means that your financial advisor, if they're not paying attention to commodity markets and physical metal availability, might be giving you advice based on outdated assumptions about how these markets function. The Bank for International Settlements estimated in their last quarterly report that total precious metals derivatives exposure across the banking system exceeds $1 trillion when you include gold, silver, platinum, and palladium. Silver represents a smaller portion of that exposure, but it's concentrated among fewer institutions, which makes the risk more acute. When a $1 trillion market begins to fracture along the fault line between paper and physical, the implications extend far beyond the people who own silver. Currency markets could react as investors reassess the role of precious metals as monetary alternatives to fiat currency. Stock markets could see rotation out of financial institutions and into commodity producers and hard asset companies. Bond markets could experience volatility if the silver crisis raises questions about broader counterparty risks in the derivatives market. This isn't fear-mongering. This is recognizing that financial markets are interconnected, and stress in one area tends to propagate to others. You remember how I started this by telling you that something broke in the financial system on Thursday? The algorithms that maintain the illusion of infinite paper silver backed by minimal physical metal stopped working. They couldn't suppress the price anymore because the physical demand overwhelmed their selling capacity. That was the crack in the windshield. What happens Monday morning and in the days that follow will determine whether that crack spreads across the entire glass or whether the system finds a way to contain it. My analysis, based on the Shanghai premium, the vault inventory data, the ETF redemptions, the mining stock divergence, and the LBMA emergency meetings, suggests the crack is going to spread. The mathematical reality of 2% delivery demand requiring $145 silver to clear the market isn't something that algorithms can solve. It's a physical constraint that no amount of paper creation can overcome. This is not the time to panic. This is the time to understand. The Americans who recognize what's happening right now, who understand the difference between paper promises and physical assets, who see the signs that smart money has been repositioning for months, those Americans have the opportunity to protect themselves and potentially benefit from what's coming. The algorithms died Thursday afternoon at 88:30. The emergency meetings happened over the weekend. The mathematical requirements are clear. The scarcity phase is beginning. What rises from the ashes of the old paper system is a market that respects physical reality instead of financial engineering. And that market is going to look very different from what we've known for the past several decades. Monday morning starts in just hours. Watch the London Open. Watch for LBMA statements. Watch the delivery data over the coming weeks. And most importantly, understand that you're witnessing a historic shift in how precious metals are valued and traded. The people who recognize this early will have made a decision that protects their financial future. The people who wait for mainstream confirmation will be trying to buy silver that's no longer available at any reasonable fiat price. The 378-to-1 trap has sprung, and there really is no emergency exit for the shorts this time. The question is whether you'll be on the right side of this transition when the dust settles. Make no mistake, we're no longer in a period of investing. We have entered a period of survival of the prepared. As the sun sets this Saturday, remember that the digits on your screen are just ghosts of a dying system. The physical silver in your hands, that is the only truth left. The banks are screaming because they can't print their way out of a shortage of atoms. They've run out of time. They've run out of metal. And come Monday morning, they might run out of excuses. This is the moment we've been stacking for. Watch the London Open, keep your eyes on the Shanghai premium, and most importantly, hold the line. The algorithms are dead. The real money has returned. Keep calm and keep stacking. I'll see you on the other side of Monday. Peace.